Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Friday, December 30th, 2022. It's 4:08 p.m., so the markets are closed. That's the final trading day of the year, of course. Just a reminder, markets will be closed on Monday in observance of New Year's Day, which falls on Sunday. So we'll pick things up back on Tuesday. And, if there's anything out there, and I'll probably over the weekend to sit down, study the charts, and but this will be what I'm going to do here is just kind of recap things short and long term. Starting out here, this is a monthly chart, something I've covered more and more recently. This is the big picture. This is what I consider to be one of the biggest bull markets in history. It started back technically in the NASDAQ, it was in November of 08, and then everything else bottomed in March of 09, and that's when you started this new supersized, we'll call it bull market, a la the Fed with their easy money policies and excessive stimulus. And again, to recap that primary trend line has been broken. So this is for a long-term investor, 401k type money, that kind of thing. This is one of, if not the most important time frames. And so by this time frame here, we had a solid close below my primary bull market uptrend line, ending, officially ending that bull market. Now officially it ended right there at the top, but once we broke that uptrend line, that was obviously a pretty powerful sell signal. And since then, you can see that we've back tested since the breakdown candle. We had 1, 2, 3 months, including this month's back testing. This time around, we got rejected. We closed at the bottom there of that candle, that red candle. So that formulates my longer term view, and as I've said many times over, until and unless this changes, I still think we're in a bear market with more downside to come. Now I'll transition over to the short-term charts, give me my thoughts there. Okay, not only the uptrend line, that's one thing. Trend lines are important. They're not the be-all, end-all. You also had what I've covered many, many times in the past is one of my favorite long-term indicators on a monthly chart, the 20-period exponential moving average. So you have this blue line here. You can roll back into the late 80s, early 90s, and I would task you to try to find a more reliable indicator, or more effective, when factoring both the reliability and the simplicity. When we're talking a single moving average, and essentially, as you can see that blue line here, this is not a freehand tool, but I'm just using a line tool. When the market, in this case the NASDAQ 100, is above it, you are in a bull market, bull trend, 401k, long and strong. When you are below that, that is a sell signal, tells you the primary trend has changed. That was the greatest bull market in many, many decades up to that point. That big run up into the 90s, the dot-com bubble popped right there. Market peaked in March of 2000. Then shortly after that, we went on a sell signal. It said, get your money, your 401k money's out of the market. If you short, that's when you want to be short. And we had followed a great bear market, a very profitable to trade bear market. And then you can see, and you stayed clearly below it after taking out that 20-month moving average. You regained it here. This was the next bull market. It was a bull market by all metrics, but kind of not nearly. It wasn't supersized like the dot-com bubble or this we'll call this the Fed bubble, but we stayed above it. And again, you zoom in and just look at each and every pullback. Tells you that's when you want to buy. You get the corrections back to the level. But when you lose the level, like you did right here, it said the bull market's over. That was the 2007 to 2009 bear market. It doesn't look like much. It was a 55% or so drop in both the NASDAQ and the S&P 500, but you can see how much bigger the dot-com bubble was. So pretty much, guys, the bigger the move up, the preceding move up, especially when you go parabolic like this, the bigger the drop. That was, I think, in the NASDAQ, even the NASDAQ 100, which are the largest, most stable companies, that was still an 82% drop right there, that bear market. There's 55. It doesn't look like much, but again, that, it's more recent. A lot of you listen to my voice probably went through that one if you didn't go through the one before. And then again, you can see it said, okay, bear market over. Officially ended back here, but this trend indicator said get long and strong. Buy pullbacks to the 20-month. You will be rewarded. All that matters on a monthly chart is how the candle closes. So you see these skinny parts. That's called the shadow, or down below they call it a wick. I'm sorry, a tail, wick when it's above. And that just says intramonth. You pierced it only to recover and close the month back and holding it and keeping the buy signal intact, even when COVID hit. Same thing, you pierced it intramonth. So again, I've covered it many times in the past, and so that coupled with the trend line, we took it out there. That was the first solid monthly close, clearly closed below it. Back tested, back tested, back tested, back tested, boom, rejection, and we're still below it. Okay, so that's my point. I can do the same thing with the S&P 500. We're being a little redundant, but it's important. That's also a very important index. Close on it there, and there is our breakdown candle. And then every single month, except this one here, we're still below it. Every single month we tested it and we got rejected again this month. So again, we're in a bear market. And based on the scope of the bull market leading up to this and many other factors, many of those fundamentally as well as technically, this charts are technical analysis. Fundamental analysis is excessive money, rising interest rates, runaway inflation. Those are fundamental factors that go into my analysis. So I think we're going to be in for a long bear market, but a very, in my opinion, very profitable one to trade, because I think there'll be some very clear and powerful rallies within there. Little mini bull markets, we'll call them, within a larger bear market. I think this one's probably going to go on for years, and so so far it's been 2022 will go down in the books as the trader's market. It's very much been a trader's market. We've had a lot of nice rallies to catch and a lot of downdrafts, or down swings to trade. Okay, that's it. And if I turn on the lines for the S&P 500, there's my primary bull market uptrend line as well. So, all right, that's enough. Didn't want to beat a dead horse, but it's important to kind of show you where we finished the year. Oh, and then you had the downtrend lines as well. In the S&P 500, remember, this is where our bear market started. Here's our bear market downtrend line. So, again, what changes my longer term outlook? A solid monthly close above both the downtrend line and the 20-month, which would happen together. There's the 20-month right here, and a recovery of the uptrend line as well. And same thing in QQQ. There's our primary downtrend line since from the bear market highs, bull market highs, end of the bull market, beginning of the bear market. And you can see we closed the month back testing, still below the primary uptrend line, and then we got rejected off after taking that out. We got rejected off that. So there it is. Okay, nothing. Now let's jump all the way down. We'll glance at the daily. My daily chart's a little busy, but kind of recap. Before we got up here, I laid this out as my what I call most likely bounce target zone, and we hit not being shown here. We had a perfect tag in the pre-market session, which was highlighted at the time of the primary downtrend line and the 200-day moving averages, both the exponential and simple moving average, these two red lines there. Again, it happened in pre-market, so it's not on this chart, but that was right there. So I highlighted the initial tag of that level as well as that one. It's objective swing shorting ops, and so far, so good. That's kind of longer term stuff, but when we go down to the 60-minute charts, let me turn back my lines. We're going to step down here. As I highlighted recently, made a near-term bullish case based on these bullish falling wedge patterns on the 60-minute charts of QQQ, SPY, NQ, the NASDAQ 100 futures. There's our positive divergence. There was the breakout. Rallied up. First resistance is 267.36, give or take. Hit that, and then bounced back. As I said yesterday, I told you, not at the risk of oversimplifying it, I said a break below yesterday's lows would be bearish, and we came close, but we didn't take it out. We came just reversed a little above that, and said a break above yesterday's highs would be bullish. So today really didn't tell us much. You see a red candle, but basically we'll close flat. In fact, right after the market close, you can see this is this is the close today. We're down about 0.04, so basically flat on the day. We recovered a nice recovery off the lows. And then the futures went positive after the close, so they're still going up. As I suspected, we see buying a lot of money coming into those FANG stocks, some short covering. You're going to get nervous shorts, especially when there's a high short interest. And there's always going to be a higher short interest when you see a drop like this. This is where, a lot of those shorts, they didn't want to short here or here. They thought the rally was strong. They wanted to buy when we were shorting, but this is not a time to start shorting. So those that are down here need to be worried about a potentially big pop on Tuesday when the markets open for the year. And look, it can go the other way. I have to say that. I wish I could tell you with a strong conviction. Like I said, near term, I do still favor some more upside. So to me, it's just a matter of what I think is going to happen and go the other way. But I think we'll get another pop, let those 60-minute divergences play out. It could be another run back up to the trend line in the 200 days again. This is a weekly chart, of course. And, if we gap down big on Tuesday and we take out yesterday's lows, then we may see a quick swoon down to my fourth and what I call my final let me phrase it right, my final initial bear market target. Because again, I think that this is just the beginning of a much larger bear market that's going to have a lot of rolling bulls and bears in it. In other words, I think we finished a secular bull market and we're embarked on a new secular bear market in equities. And in there, there'll be plenty of smaller, what we call cyclical bull and bear markets. All right, so that's that. And again, weekend, you're going to have extra risk. So here it is in a nutshell. Again, we're bouncing between this. This has been a recent trading range. We had that one little drop below, followed by a quick recovery. So what you want to look for next week, let me keep it very simple. A pop above 267.36 or so, right there, right? Bullish. And I think that would give us a run up to my max bounce target around 280 right now. That would be a gain next, might not necessarily happen next week. It could easily. That's 5%, 5.2%. Or a breakdown below, and that's going to be bearish. All right, and other things I'm on the lookout for. You have a potential bearish PPO crossover. Sometimes it looks like you're going to get it, and then the lines bounce. You can see the PPO heading down. That was our last bearish PPO crossover on the weekly right there. There was a bullish crossover. These are pretty good trend indicators. There was a bearish PPO crossover right there. See, there aren't many. This is the weekly chart. So since the bear market, it started back here and for the NASDAQ in November, and that was our a bearish PPO crossover. You can see the line the PPO line stayed below the signal line all along and went positive there, helped confirm this rally, that bull market rally that we caught. And or bear market rally, I should say. And then you got a bearish crossover, bullish crossover right there. Caught this rally over the last few weeks, and if it crosses, we get a bearish crossover there. However, you still have the divergence. Remember, that was a divergent low. And here's the thing, guys. Any new low, let's just say we're not far from. Let's say we pop down. Undercut the lows, we're going to have positive divergence. We're going to have positive divergence on the weekly chart unless we take out this low right here. So, and that's possible. That's going to be ugly if that happens. But like I said, I'm kind of leaning towards a New Year's rally is what I'm leaning towards right now. And, if you're confused what to do, Randy, are you long, short? Well, I told you I've took some, still have some swing shorts in my longer term accounts, but I've taken some indirect hedges against those. Stocks like Apple, Amazon, and Tesla, the three I named yesterday. And what my plan is, let me be clear, is if we crap out next week and we undercut the lows, I'll remove the hedges. If they start breaking support, I'll throw those away and then just have pretty much a naked short on the Qs on my long-term accounts. Trading accounts, I'm going to go in, I'm going to go into next week with a mild long position. Remember, it's a 3-day weekend, so no reason to get overly aggressive. All right, so 60-minute chart. That's it. I don't want to be a dead horse. SPY. This is what SPY looks like. Also coming off a divergent low. And there's the primary downtrend line. I'm rolling back here a little farther. I can give it to you on the daily chart. It's kind of busy here, but here you go. There's your primary bear market downtrend line, comes off the highs right there, and we've been, rejected off of it. That's the top, second reaction, third. That was our most recent reaction there, and we could make another run at it again. And again, if we take out by a wide margin the 200 days, I've talked about this a lot. 200-day moving averages, especially the blue one there, the 200 simple, often acts as a very objective point to exit longs and or enter or add on to shorts in a bear market. But it's not unusual to take those moving averages out by about a week or so, overshoot them, and so you got to give them a little room. But you also have the downtrend line there. That downtrend line is now very significant. I don't think there's anybody that's even a rookie in technical analysis that wouldn't pick up on that. That's a very important trend line. So these are things to watch. It's a potential bounce target if we do get a New Year's rally, and anything much above that again has the potential to change it, obviously here on the daily, but potential on the weekly and monthly. And so what happens is sometimes you can pop these in a bear market on the daily time frame, maybe by a few days, only to reverse back below, and that's a false breakout. So depending on your time frame, if you are a long-term investor, again, talk 401k, IRA monies, then you might want to give it and wait to see a solid weekly close above this trend line. You just go to a weekly chart and wait till the Friday close, or even you can even go to the monthly charts there, and that might keep you out of the market if you are out of the market in your 401k, or if you're swinging. If you're swinging shorts and you're not a very active trader and you shorted back here, we had a lot of opportunities, you're still very profitable, and that would help keep you in that for what may be the next leg down. All right, NASDAQ 100 futures right here, NQ, nothing really new. This is the most recent downtrend line I showed you, so that and that together form the bullish rising wedge on the 60-minute chart of NQ. Mentioned we had an impulsive breakout, resistance there at 11,044, give or take, 11,045 we'll call it. I added this line today because you can see that was support there, and that's what we pulled back to. And so, like I said, this is the same box right here you have on QQQ. This next week, if we break above, I would continue to favor a move all the way up to that 280-ish level on QQQ, which roughly aligns with this level here on the NASDAQ 100 futures. And of course, if we break to the downside, that's not going to be good. It may usher in, the next stage of selling, but I wouldn't go too heavy short because you're still going to have a negative divergence. See the divergence? I'm sorry, positive or aka bullish divergence. So let's show you that scenario. Let's just say your markets come out of the gate on Tuesday, gap down somewhere in here. You can extend that line, and they may. And we've seen a lot of this year where the recent lows get undercut. Bears pile in. That's usually, and they call it a bear trap thing. After if the market reverses and then regains the low. So that's what you want to watch for. So I would be a little hesitant to short. Now you could do it, but if you do short a gap down that takes out the recent lows, and you see a pretty powerful recovery and it's on volume and you get back above that level, then you may want to cover that short and or jump in and get long. All right, so that's the markets in a nutshell. Since it is the end of the month, end of the year, I'll just go over the other things that are out there. I already gave you an update today. This is that wheat trade I threw out last week, or week before. I think it was 6 trading days ago. That is the first target. Our buy signal was right here, right shortly after I got that post out to you. And nothing big, about 4%, but again, remember we are in what I believe to be at least a early stage bull market in commodities. So we've had a nice correction in a lot of these commodities, ag commodities in particular. So you want to start looking for re-entries on those. So there's wheat, hit the first target, and a typical reaction. Reaction I define as a pause, a consolidation or a pullback. So you have more of a pullback. A little bull flagish type action. You can see the quick thrust up followed by this more like a bullish pennant, And so next week, if we pop up, that should take us to that next target at 820. I know not all of you trade futures, so I gave you in the original post a week or two ago wheat, W-E-A-T, the ETN, big positive divergences there. It had nice support here at about 777, which it broke down. And again, this is a story of this the market, just like the stock market. You tend to undercut these big support levels. It shakes out a lot of the weak-handed longs, sucks in some shorts, and then once you recover, that's a pretty powerful thing, and that's what we've done. So it's still bullish on wheat and the other grains as well. Treasury bonds. Let me give you a little more. I got the post out to you today with a ZB, but here's TLT. I gave you a TLT and Treasury bonds, and ZB is a short trade idea here recently on a break of this trend line, and that was a very nice swing trade if you caught it. Of course, we also went long here. This has been a great swing trading vehicle, Treasury bonds, and I think they will continue to be a nice swing trading vehicle in 2023. The key with Treasury bonds, I say this often, most of you, India, they move up and down 1% a day, not much. The thing about it, because they are lower, less volatility, you just take a bigger position size. You can use more leverage. Futures are, of course, inherently leveraged. You can use TLT. There's also some ultra two-time. What is it? I forget offhand. I trade the futures, but you can trade that as well. The two-time leverage. All right. So where am I going with this? So we caught that. That was a nice sell signal, and I think we're getting very close to a buy signal. This would be the trend line. Let me add it here on this chart. That uptrend line on the 60-minute chart. It looks like this. We broke it there. As I said, yesterday, I would see easily one more thrust down here to that 98.38 level, and if we get it, I think that would be a good re-entry point because that's support, or a good entry point right there, 98.38. And that would also, if we get down there, let's say we gap down on Tuesday, then you're going to have, if you reverse and hold it there, you'll have some nice positive divergence. So there may be a long side swing trade coming up there. And ZB or your futures, this is what it looks like. Again, I got this chart out to you earlier today. Mentioned as a setup. A setup is not an actionable trade, something pending an entry. You need to clearly take out this downtrend line. That's what we didn't. We're right about on it. And of course, the week is over. You had this bearish rising wedge. That was our last shorting op right here on that breakdown, and that was a nice trade. And now I'm getting ready to go long. This is that level I said. If we come down on the futures to 122.293, that even if we haven't broken out above the trend line, there are two objective times to go long on a position, or take a long trade, either on a pullback to support that if it's a support level that I think a bounce is likely, I will buy that. If it's a support level that I think is going to break, then I'll get ready to position to go short. But in this case, we'd be oversold. There's numerous reasons, including but not limited to these positive divergences, and we may not get down there. So the other objective entry, other than a pullback to a 122.300 or so, would be a break above the trend line, and then you can see my targets marked. Max target right now would be about 125, 129, 154, whatever that is. And then, of course, I like to always align my Treasury bond trades with the yields of the Treasury bonds. This is the 30-year Treasury yield, and again, so yields were rising. That was one of the biggest increases in the 30-year Treasury yield in many years. That was the Fed trying to extinguish the flames of inflation by raising rates. The rates shot up, but for numerous reasons, including and not limited to the weekly charts and everything else, that's where I was looking for a pullback. So there was our sell signal in yields, but a buy signal in Treasury bonds. So remember, yields go inversely. So when yields fall, bonds go up. And so here was that last rally. There was the breakout of the trend line. This is just looking at ZB or TLT and ZB in reverse. And so what I'm doing is making the case that the upside is limited. Here's that uptrend line right there. And so if we can just get one little little drop down in Treasury bonds to those support levels I talked about, that should coincide or would coincide with a back test of that trend line yields, and that would help support the case. You'd also see a rejection here. The PPO, the zero line is a pretty good trend indicator. When the PPO is above the zero line, the trend is, you got it, bullish. Once it crosses below, the trend is bearish. And that zero line often acts as support when tested from above and resistance when tested from below. So that's what we're looking at there. Okay, Treasury bonds, gold. Like I said, I'm still longer term bullish on gold and silver. They're holding up, but they're kind of just stalling out recently, both gold and silver. There are some divergences, and of course, the big thing is the euro and the dollar. So when I look at silver, let me show you. I see this uptrend line right here. We may be looking at a correction. I've been longer term bullish on it, but I think too many people are starting to get bullish on gold and silver after this rally, and there's pretty good resistance on that downtrend line on SLV, the silver ETF. There's the what looks like a bearish rising wedge. So if we break that, we get a correction. Let me show you what the silver futures look like to SI. You can see a nice uptrend line there. This is a 6-month chart with 2-hour candlesticks, 120-minute, and you can see that same uptrend line right there. You can see the negative divergence forming. And so if we get a correction in January, coming when the new year kicks off next week, how far down? This would be my max pullback target, 21.15, and a potential target. So any or all of these are potential targets, and so consider this a trade-off as well, or a setup. A break of that level, you want to be safe. Benefit of the doubt, about 23.65 on SI silver futures. That should do the trick, because that's a minor price support, and it's also going to take you below the trend line. So that's a setup for next week or whenever going forward. We can still go higher, but unless we take out the trend line, that we're in an uptrend there. All right, and of course, we say, the euro, U.S. dollars, where the gold and silver move. They are positively correlated with the euro, which means they're negatively correlated with the dollar. And when you look at the weekly chart here, you're a little bit above the downtrend line right now, but not by a large margin. So we're getting pretty overbought. We're not completely overbought on the weekly chart yet, but getting there, and you can see some divergence and also price resistance as well. So this is why we had a strong run that coincided with a strong rally in gold and silver, but the momentum is waning, and that's what you can see from the momentum indicators. That's why they've rolled over and they're turning down. So maybe one last pop up in the euro next week, but you get pretty good resistance right here. And I do remain longer term bullish on the euro, which is longer term bearish on the dollar, and that also means longer term bullish on gold and silver. Just near term, I think we might get a little pullback, and that would also mesh with a rally in the equity. And this is still my pullback target right here, this uptrend line, and that would also may align with a rally, an early January rally in the stock market, because gold and silver have been finally starting to catch a good risk on bid. Risk off when the market's been falling lately for the last few weeks. And that people have been moving money into gold and silver. So if the stock market rallies and those divergences play out on Apple and Amazon, which are still some of my favorites right now, Apple at support, covered yesterday. If you haven't seen that video, watch it. We haven't made a solid recovery back above that previous low, so it's still anybody's game right now. I'd really call it more of a back test with potential. So if we do next week pop up, then all those that shorted Apple on that break, they will start to be squeezed out and cover. And again, I give you a potential bounce target up to this downtrend line in Apple, and that coincides roughly with the downtrend lines in the market, not perfectly. Amazon is another one of my favorites, mainly because it's at long-term support on the weekly chart here, that 83-ish level right there with some positive divergences, even on the daily chart there. But what you want to see next week, bullish if Amazon can break the trend line, and of course it's going to be very bearish if it falls, especially on a weekly closing basis below that 83 support. So that's one to watch as well. And Tesla, I told you yesterday when I got back into town, typing the wrong things here. Tesla looks like a potential selling climax there. Let me move that up a little bit. You can see big volume surge, and it's been green last 3 days, including today. So that is a potential bottom, and that one, if it does rally, there's a downtrend line you still have from where we closed today. If it gets up to that downtrend line, which is very possible, that's about 26% rally. So I can tell you this: if the Apple, Amazon, and/or Tesla, if they do play out these divergences and these bounces off support, they're gonna take the market up with it. They're the market leaders, the top weighted ones, and again, they may crap out. So what you're gonna look for next week or in the coming weeks, if Tesla takes out the recent lows, Apple takes out the recent lows by a good amount, Amazon takes it out, then we're probably gonna have that final wash down move. Remember the VIX, I've covered this quite a bit recently too. The VIX has these series of downtrend lines, especially since the bear market started. This is when officially, at least in the NASDAQ, it started in November, in the S&P right around the beginning of the year. And you can see you have these clean downtrend lines. I've covered this many times. You break out and you don't run right away. You have these periods of consolidation after the breakout, then the big run move comes. And these are all the big legs down in the stock market. So that was trendline break 1, trendline break 2, little consolidation, then the rip, down trend line. That one broke and just ripped up. But the rest had the trend line breaks, and then we consolidated and then exploded higher. So again, that's why I kind of have the mixed thoughts, like the bearish longer term charts, and so this is what we're watching. And look, it's pretty simple, I think. If we undercut the recent lows, I keep talking about the last couple of days, if we undercut the recent lows in the stock market, Apple, Amazon, Tesla, and we start to really sell off hard, you will get that explosion in the VIX. So that's a potential trade idea. However, the one thing about it, you might say, well, Randy, that's a pretty solid pattern, and you can almost bank on that happening. One of the things over the years I've noticed, by the time I recognize a pretty clear pattern, sometimes that's just when it's about when it stops working. So this, may or may not play out as it did before. Usually these periods of consolidation were only about looks maybe a week to 2-3 weeks. You can measure the candlesticks on your own. So again, and 25 and a quarter or so, that's the recent high. That would also be a buy signal on the VIX and a sell signal on the market, I think, if we pop that recent high there. Otherwise, if the market rallies in next week into January here, you're probably going to get another leg down in the VIX. There's a potential uptrend line. I call it potential because you only have these two distinct reactions. I mean, there's several reactions in close proximity, little clusters. And so it's a potential trend line. So if the VIX drops, that would probably find some support there, and if not there's some price support right there. And that's about it. I already gave you a setup in natural gas. It's still an untriggered setup. There's this downtrend line, positive divergence, but no buy signal yet, so we'll have to see what happens next week. So I already laid this one out, gave you these two targets. Crude oil seems, remember, crude oil put in that big divergent low recently, and it's been moving higher. Oops, that's not my line tool. There we go. There's positive divergence on this daily time frame right there. Pulled back to close enough to that primary uptrend line, and it's been moving higher. And so we'll watch crude and natural gas closely, because if they continue to move up, especially get anywhere near the old highs, and again, that's an ongoing theory I've had for a while. It's this what I call vicious cycle or a negative feedback loop between commodity prices or inflationary forces, and what the stock market and what the Fed's going to do. So watch this, watch crude, watch agricultural commodities, and if they start to rally, along with the stock market, if the stock market does rally, then just know that that's going to eventually put the brakes on any stock market rally, because the more commodity prices go up, the more the Fed is going to be forced to continue to keep raising rates, or keep rates relatively high. And if you get a breakdown in crude and natural gas and commodities fall, well, that's the market's going to like that, because then the Fed might be able to eventually start lowering rates. But we'll see. All right, first things first. So let's see how next week opens up. We'll go from there. I'll get any updates out to you that on any other trade ideas that I didn't cover right now. I'll try to get something out to you Monday. I think those are the big ones I cover: energy, gold, treasury bonds, and the stock market. So, and I gave you, of course, some individual stock ideas there as well. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend and a Happy New Year.